Central banks play a crucial role in governing the banking industry by implementing various policies, regulations, and oversight mechanisms. Their primary objectives include ensuring financial stability, controlling inflation, managing economic growth, and protecting consumers. Below are the key ways in which central banks govern the banking industry. 1. Regulating monetary policy. Central banks regulate monetary policy to control inflation, interest rates, and the overall money supply in the economy. They use tools such as open market operations, the discount rate, and reserve requirements to influence liquidity in the financial system. By adjusting these factors, central banks help maintain price stability and promote sustainable economic growth. 2. Setting interest rates. One of the central bank's key functions is determining benchmark interest rates, such as the federal funds rate in the U.S. or the repo rate in other economies. These rates influence the cost of borrowing and lending for commercial banks, which in turn affects consumer loans, mortgages, and business investments. 3. Supervising commercial banks. Central banks enforce regulations to ensure that commercial banks operate in a safe and sound manner. They conduct regular audits, inspections, and stress tests to assess the financial health of banks, ensuring they have sufficient capital reserves and risk management practices in place. 4. Implementing reserve requirements. Central banks mandate that commercial banks hold a certain percentage of their deposits as reserves. This ensures that banks have enough liquidity to meet customer withdrawals and prevent bank runs. By adjusting reserve requirements, central banks can control the amount of money circulating in the economy. 5. Acting as a lender of last resort. In times of financial crisis or liquidity shortages, central banks provide emergency funding to commercial banks to prevent collapses and maintain stability. This function helps restore confidence in the banking system and prevents widespread economic disruption. 6. Enforcing banking regulations and compliance. Central banks issue and enforce banking regulations to ensure ethical practices and financial security. These regulations cover areas such as capital adequacy, risk management, anti-money laundering (AML), and consumer protection. 7. Controlling inflation and currency stability. By managing money supply and interest rates, central banks work to keep inflation within target levels and ensure the stability of the national currency. Stable inflation rates encourage economic confidence and long-term investment. 8. Monitoring and managing financial risks. Central banks assess systemic risks in the financial sector, such as credit risks, market risks, and liquidity risks. Through regulatory frameworks and financial stability reports, they identify potential threats to the banking system and take preventive measures.